The 30-year fixed mortgage rate is one of the most watched numbers in American housing, but most people do not really feel the rate until it becomes a monthly payment. A rate can look small on a screen: 6%, 6.5%, 7%. Those numbers look close together. But inside a 30-year mortgage, a 1% change can move thousands of dollars every year. That is why the 30-year fixed mortgage is both powerful and dangerous. It gives the buyer a stable payment, but it also stretches interest over a very long period. So in this video, we are going to break down the payment math buyers miss. Let us start with a simple loan. Imagine a buyer borrows $320,000 at 5.5% on a 30-year fixed mortgage. The principal and interest payment is about $1,817 per month. At 6.5%, the payment is about $2,023 per month. At 7.5%, the payment is about $2,238 per month. The loan amount did not change. The house did not change. But the monthly payment changed by more than $400 between 5.5 and 7.5%. That is nearly $5,000 per year. And that is before taxes, insurance, HOA fees, mortgage insurance, repairs, or utilities. This is the part buyers feel in real life, not the rate itself. The payment. Now look at it from another direction. Suppose a buyer can afford a principal and interest payment of about $2,000 per month. At 5.5%, that payment can support a loan of roughly $350,000. At 6.5%, it supports closer to $316,000. At 7.5%, it supports closer to $286,000. That means higher rates do not just raise payments. They reduce buying power. The buyer may qualify for less. They may need a bigger down payment, they may need a cheaper home, or they may be pushed out of the market entirely. This is why mortgage rates and home prices cannot be separated. If home prices stay high while rates rise, affordability gets crushed from both sides. The buyer is paying more for the house and more for the money used to buy the house. That is the double squeeze. But there is another side to the 30-year fixed mortgage. It can protect the borrower from future rate increases. If you lock a fixed rate, your principal and interest payment does not rise just because market rates rise later. That stability is valuable. Rent can rise, insurance can rise, taxes can rise, but the loan payment on a fixed-rate mortgage stays fixed. This is why many homeowners with low mortgage rates do not want to move. If they sell, they may have to replace a 3% mortgage with a much higher rate. That creates the lock-in effect. People stay in homes longer because their old mortgage is too valuable to give up. That can reduce inventory. Lower inventory can keep home prices firmer than buyers expect. So higher rates can slow demand, but they can also keep some owners from listing. Housing is not a simple machine. Now, let us talk about total interest. A 30-year mortgage keeps the payment lower by spreading the loan across 360 months. That helps affordability. But it also means interest has a lot of time to add up. On a $320,000 loan at 6.5%, the borrower can pay more than $400,000 in interest over 30 years if the loan is held to term. That does not mean the loan is always bad. It means the buyer should understand what the payment really represents. The first years of a mortgage are mostly interest. The principal falls slowly at first. Then later, more of the payment goes toward principal. That is called amortization. And it is why selling or refinancing early can feel strange. You may have made years of payments, but the loan balance may not have dropped as much as you expected. This is also why extra principal payments can be powerful. Even small extra payments can reduce interest over time if applied correctly. But extra payments should not come before an emergency fund, high-interest debt, or other basic financial needs. The key is understanding the trade-off. A 30-year fixed mortgage is not just a rate. It is a structure. It trades a lower monthly payment for a longer interest timeline. It gives stability but not automatically cheapness. It protects against future rate spikes, but it can become expensive if the starting rate is high. So when buyers ask whether today's 30-year fixed mortgage rate is good or bad, the answer depends on the full math. What is the home price? What is the loan amount? What is the down payment? What are the taxes and insurance? How long do you plan to stay? Can you afford the payment without assuming a refinance? And what happens if your income changes? The 30-year fixed mortgage is popular because it gives buyers predictability. But predictability does not remove risk. It only makes one part of the payment easier to forecast. The smartest buyers do not only watch the rate, they convert the rate into payment, buying power, and total interest. That is the real math behind 30-year fixed mortgage rates. There is one more reason 30-year fixed mortgage rates matter so much. They shape the psychology of the entire housing market. When rates are low, buyers can often qualify for larger loans. That can make expensive homes feel affordable because the monthly payment looks manageable. When rates are high, the same home price suddenly feels heavier. The house did not change. The kitchen did not change. The school district did not change. But the cost of borrowing changed, and that changes everything. This is why buyers can feel confused when home prices do not fall as much as expected after rates rise. They think, if payments are more expensive, prices should drop. Sometimes they do. But housing supply matters. If there are not enough homes for sale, prices can stay firm even when payments are painful. That leaves buyers stuck between two expensive numbers: high mortgage rates and high home prices. This is also why the monthly payment should be tested before shopping emotionally. If a buyer tours homes first and calculates payment later, emotion can take over. The home feels perfect. The neighborhood feels right. The kitchen looks better than expected. Then the payment arrives like a surprise. That is backwards. The payment should set the search boundary before the buyer falls in love with the property. A simple approach is to choose a comfortable payment first. Then test what loan amount that payment supports at different 30-year fixed mortgage rates. What can the buyer afford at 5.5%? What about 6.5%? What about 7.5%? That range shows the buyer how much rate movement can change the home search. It also helps the buyer avoid relying on a future refinance to make the deal comfortable. That matters because the phrase "marry the house, date the rate" can be dangerous if people misunderstand it. Yes, refinancing later may be possible, but it is not guaranteed. Rates may not fall enough. The borrower may not qualify later. Home value may change. Closing costs may be too high. So the buyer should be able to live with the payment they take on today. If the only way the deal works is through a future refinance, the deal does not really work yet. The 30-year fixed mortgage can be a useful tool because it creates a stable principal and interest payment. But the stability should protect a good decision. It should not be used to justify an unaffordable one. So when watching 30-year fixed mortgage rates, do not stop at the national average. Convert the rate into your loan amount, your payment, your taxes, your insurance, and your real monthly budget. That is where the rate becomes real. Educational content only. This is not financial, mortgage, tax, or legal advice. Always compare real loan estimates from licensed lenders before making a home buying decision.